Let's crack on. Let's crack on. So, Richard, preparing for exit for small business owners. Tough times at the moment. Some just want to get out. Some want to maximise the value. Some want to really look to take their business on to the next level and leave a legacy, if you like. But, you know, as a small business owner, when should you start thinking about exit planning?
Well, actually, in an ideal world, you should have an eye on what your exit strategy is almost from day one, but that's maybe a little bit over optimistic. Certainly, you should be thinking sort of 3 to 5 years out, not necessarily a detailed plan, but start thinking about what is your timeline, what is your potential route to exit, and there are different. We'll come for some of those off in a little bit more detail, but start putting that outline plan together. Start speaking to the right trusted advisors, your accountant, your business advisor, your lawyer, because there's steps that you should be taking to start preparing your business in advance. We obviously do see business owners, particularly over the last few years with everything that's been going on, wake up one morning and go, I've had enough, I'm going to sell my business, I'm going to exit. If that's you, fine, nothing wrong with that, but you're probably not going to get the most out of it in the long term than those people who have been planning this for the years to come.
And that's interesting. You know, what are the reasons that people want to exit? You know, I was chatting to a lady earlier today, and she's mid to late 50s, and she said, I'm still working a lot of hours, and I probably need to start thinking about not working so many hours. So for her, certainly, you know, working less hours and having a better lifestyle as she got a little bit older as a driver. What are some of the reasons that people want to exit?
I think there's a combination of reasons. For some, it is just a sort of an age or a time thing. They've had enough. Sometimes it's a change of circumstance. You know, COVID. You know, and that sort of whole change of circumstance and lockdown. That was a big driver for a lot of people to go, you know what, I've just had enough. I don't want to battle through this sort of brave new world. Sometimes it's a case of they want to pass down a generation, actually want to bring the family in. Maybe they feel like they've just made enough money, or the business is worth enough money that actually they can retire and lead a very comfortable lifestyle. Or maybe sometimes it's just, I want to change. I've been running this business for however many years. I'd quite like a break and then try something different. So it's down to individual circumstance.
Yeah, and I guess there is one where sometimes in certain sectors you want to maximize your sale at the peak of an opportunity, whether it's a particular product or a service or a timing. Sometimes it's about maximizing that sale in a peak time, isn't it?
It is, absolutely. And you see that with maybe certain tech businesses or things like that. They've had a very good period of time, or actually they've just got an offer that they just can't turn down because there's someone potentially paying over market value because they've got a particular product or service, which is a great bolt on for whatever the buyer's business is currently. And it's just a once in a lifetime opportunity that you really can't turn down. You do see those come about as well.
Yeah, sure. Right. Okay. So what we're saying is that, you know, they're the reasons that people want to exit. And typically you're saying in an ideal world, you want to be planning 3 to 5 years out so you can maximize the value. And we'll get onto the value piece a little bit later. But when a business owner's looking to exit, what are some of the key priorities that they should be considering? Because it's not just as simple as selling up and throwing the keys away one day, is it? You know, what are the key considerations that business owners should be making when they're looking to exit?
I think first and foremost for many business owners it's financial. Actually, you know, what's the financial figure they need out of it, and you know, that's based on, you know, what sort of lifestyle they want to lead, what sort of their personal circumstances, things like that. We do see business owners that sometimes they've got a figure in mind that is wildly unrealistic, or the other end, we've seen business owners actually the business is worth far more than what they think it is, and they go, oh, I don't need that much money. So financial is obviously going to be a central driver, but it's not the only driver. You need to look at there's a lot of people who have a loyalty to their team, to their staff, and actually how are they looked after in the long term. You know, they've probably been integral to building the business, and that might be staff collectively, it might be a certain small number of staff. It's different for different people, but that's a key consideration. You know, there's a lot of business owners who don't want to sell a business and go, well, all these staff are now going to be made redundant and things like that. Legacy is one. Actually, we've spent however many years building this business, and I don't want some other company to take it on and, you know, we just get swallowed up and actually that legacy is lost. It could be family related. Actually, you might have a a son or a daughter or a niece or something like that you want to bring along into the business, and actually that there really needs to be a process for that to get that right. So there's a lot of priorities, and it's different for different individuals, and it always amazes me when you sit down, speak to business owners, actually, the breadth of considerations that some of them have. Some of them actually don't even want to retire. They want to, get the money out and just carry on working. They don't want the hassle and the stress of necessarily owning and running a business. They just want to actually become employed and stay in it. And that's another consideration. Whether you just want to get your money but still not want to step away from the business. So I think it's an important point generally for business owners to give us some proper consideration as to, like I said, not just financial, but on a broader basis, what is it that they're looking for longer term, and that ties in with your old personal life choices, and where do you want to live, and what do you want to have, and where do you want to go on holiday, and all of this. It's not, and you can work backwards from there.
Yeah, so in summary then, financial reasons, time and lifestyle reasons, look after your team, legacy, or kind of family commitment. So there's a number of key priorities to consider, and they're going to be different for every business owner, aren't they?
Yeah, absolutely. It's not a one-size-fits-all solution here, and it really is down on the individual. Another dynamic that comes into play here as well is there are businesses, a lot of businesses, which don't just have one owner. You may have multiple owners. You may have 3 or 4, 5 people who are all at different points in their life and have different priorities. Yeah. And actually having an open discussion around that is so important, because what you don't want is have one business owner going, well, I expected us to be running this for another 20 years, and the other one going, well, I expected to retire in 3. Because actually it's amazing how many business owners don't have that conversation, and they get themselves into a bit of a hole, because all of a sudden one goes, I want to retire, I want to exit, and that's not what the other one is expecting. So it's not necessarily just a one person consideration. You need to be thinking as a management team, as an ownership team, because that will then also impact on your options and your discussions as to where you go with this.
And that's why you say it's better to be having that discussion earlier rather than later. If you're planning 5 years out, and then somebody's saying, well, I want to be out in 3 years, then at least you can work on both pathways, can't you?
Exactly. And as I said, once you've got an understanding of that, you can then plan your options around that. And ultimately, its timeline is one of the central themes, but you need to be having those conversations in a very open manner as well.
Okay, so just to put some context in this, then we've decided we want to exit. We're planning 3 to 5 years out. We know what the key priorities are in terms of the legacy that we want to leave and the benefits that we get. It then comes down to a transaction. There's different types of transaction when you're looking at exit. What are the kind of key transaction types that you're seeing and hearing in the market right now?
Yeah, so I think most people's starting point when they think about an exit is, I'm going to sell my business. There'll be a competitor or whatever. I'm going to sell it to somebody else. And for a lot of people, that is very much a viable option. There's some pros and cons to each avenue, as you'd probably expect, but that's not their starting point. Whether that's the best avenue for them depends on a lot of other circumstances, actually. And it goes back to the priorities, actually, about how much money do they want, when do they want it, they want to do about team and legacy and all the rest of it. But trade sale is certainly an option. You might want to look at something like employee ownership. This is relatively new. The number of what we call EOTs has grown by 250% in the last 3 years. It is very much rising, and there's a number of reasons for that. Firstly, sellers can sell their business and not pay any tax. Employees can take tax-free income, and it really helps drive the culture of the firm going forward. It is quite specialized advice, but that's an option. Management buyouts. So actually you select a smallish series of managers within the business, and we put in a structure for them to buy the business. within a new entity, and the structure around that. And actually, you can end up having a combination of those two latter options. You could do both an employee ownership trust and a management buyout as to the different shares that they acquire in the business. And again, that needs some planning around that, but that's how you probably get a bit of a hybrid between rewarding the key drivers in the business, whilst also rewarding the entirety of the staff altogether as well. And then obviously family succession, that again needs some planning, whether that there's a sale there as such, and in terms of a transfer of ownership and money, or whether that just happens actually potentially in the will. From a tax side, that could actually be more beneficial, but probably doesn't result in the owner having any real value in the short term, buying maybe dividends. So there's pros and cons, but that's kind of your 4 core bases. There are other options, but that realistically, if you're sitting down with a business owner, as we quite often do, and we look at what's their avenue, what's their options, we're talking that 3 to 5 years out. We kind of go, right, here's how you prepare your business based on which avenue you want to go down. Trade sale, there's advantages to that. We can come on to that. Employee ownership, right, this is what you need to be doing. Management buyout, this is what you need to be doing. Family, well, actually, that's not entirely a legal consideration. Sometimes there's a training need there and things like that as well.
Yeah.
So there's plenty to be going through. But that's why we're going back to thinking 3 to 5 years out is the best time, because then you can start getting your business into the right lane to maximize the value, maximize ultimately what you're wanting to achieve out the other end of it.
Yeah, absolutely. And I ran an in discussion webinar with Mark Fitzgerald, Cook of Intelligent, recently, talking about how to maximize your value at sale. And there's a lot of overlap with this today. And I know you work very, very closely with Mark.
Yes.
And he was talking about the kind of key considerations to maximizing the value. And he talked a lot about start early, have a plan, and then work towards executing that plan. So you've talked about the 4 main options there. As I say, that there are many, many others, but the 4 main options in terms of kind of trade sale, employee ownership trust, MBO, or succession.
Yeah.
What in at top level terms, for those that are not as kind of clued up as you and I on this, what are they? What are the main pros and cons of those 4 options? Okay,
so a very high level, going through each of those in turn. Trade sale, pro is you are much more likely to get the full value or the majority of the value of your business paid on completion. Caveat to that is actually, I would say the majority of transactions, certainly anything over about $250,000, involve an element of deferred payment. So you're probably not going to get all of it, but you're much more likely to get the majority of it on day one. Okay. And it normally allows your route to just step away. You might be kept on for a period of time depending on the nature of the business, but you're more likely to get to a full exit sooner, shall we say. Disadvantage is the nature of the due diligence process, and the legal process is likely to be much more rigorous. You've got to have someone completely independent of the business, no prior knowledge, and they're going to pore over everything. So all of those skeletons that you think are tucked away in the closet, well, they won't be for very long, because they're going to want to know about it, and they're going to want to look at your employment contracts and your supplier contracts and your customer contracts, insurance policies and bank statements. And that is quite an onerous process. And it can result in renegotiation about the price, and actually what you start with might not be what you end up with. So it's, I wouldn't say it's an adversarial process, but it can be more contentious, shall we say, than some of the other options. It's kind of your biggest drawback to that. The second one, employee ownership. Well, your biggest advantage of that probably is twofold. One, tax, as I've already mentioned. You sell your business, you can sell it for 500,000 or 50 million, you don't pay a penny in tax, so you can save significant sums of money. Secondly, it's culture. Actually, all of the research, all of the stats show that businesses who become employee owned do end up showing significant increases in productivity, culture, and ultimately turnover. And we're an employee-owned business. We've certainly seen that as well, because all of the staff get a buy-in, they all get a cut of the profits, and they also get that without having to pay any tax as well, up to 3,600 a year. So culturally and for the long-term security of the business, it has a lot of benefits because you don't have to worry about future sales and things like that. The disadvantage, it is a fairly complicated structure, and actually the preparation work is quite complicated. It means having to go to HMRC and getting clearance and getting business valuations. It also means setting up a trust and getting trustees and things like that. So the structure itself and putting it in place is not as straightforward. It also means that you are probably going to be paid out over a period of time. You might get a chunk of cash on completion, but more likely than not, it's going to have to be funded out of the profits of the business over a period of time. So that can be a downside. Management buyout, similar in a way to employee ownership. The difference being is instead of benefiting the employees collectively, fully, you're actually identifying the key individual or individuals within the business who is your succession plan. Advantage of that, they already know the business, they're probably already managing the business to some extent. They're going to be incentivized, they're going to know how to grow the business and probably will protect that legacy that you've been building. The disadvantage, similar to an employee ownership trust, you're probably going to be paid over a period of time. It's unlikely you've got an employee manager who's going to have the money to buy you, or going to be able to raise the money to buy you out in one go. And obviously you don't get the tax benefits of an employee ownership trust, which is why some people combine the two to get a bit of a hybrid. So there's a few options there. And finally, family-run businesses. Well, the big advantage of this, of course, you're keeping it in the family, you're keeping it all together, and generationally that can have it can build family wealth collectively, and you all the benefits that come with that. The disadvantage of that is statistically the failure rate on family businesses being passed down from generation to generation is very high. I forget the exact stats, but I think it's something like over 50% of family businesses actually fail from passing from first generation to second generation. And that, I would say, it goes back to the fundamental point that we started with, is it's a failure to prepare. Actually, the children most probably are not ready and haven't been trained on stepping up into that ownership role, and maybe haven't gone through some of the hardships and difficulties that a parent have, so maybe are not as well prepared. There can also be considerations as to actually how is the parents, assuming it's the parents or grandparents or what have you, are paid out, or and how that's structured, and is that structured at all, or is this almost like a gift? And there's some relationship issues to be juggled there, which can be a little bit more complicated.
Yeah, and thanks for those pros and cons, and there's a lot of insight in there. Certainly from my experience of mentoring many small family-owned businesses over the years, that I always see that the children are rarely as entrepreneurial. Mm-hmm. Whether it be the grandparents or the parents, are very entrepreneurial. They've seen an idea, seen an opportunity, and gone for it. And then the children come along, they're not as entrepreneurial, they're not as bothered, they're not as invested in the business. And those that work in the business almost are working there because it was easy to go work for the family. But I often find that they're not as entrepreneurial, and that's one of the reasons for failure, is they're just not on the same wavelength.
And that can be why it isn't always the best solution to pass on to the family, even if the family are working in the business. Actually, we do have transactions where we advise owners and their sons or daughters or whatever are working in the business, but they're not the succession plan because they don't have that entrepreneurial spirit, that leadership drive, and the parents recognize that. And there can be ways and means that you can structure an exit whereby the kids still financially benefit, but are
Yeah.
not necessarily expected to be the ones that are making the decisions and ultimately running the business. And again, it goes back to the point of being prepared and actually being realistic as well about what's the strengths and weaknesses of the family members, and actually are there better drivers in the business.
Yeah, and conversely, I've got a friend at the moment he's just taken the family business over from his father, who's taken a back seat, and the son is a lot more entrepreneurial, and that's great. But his dad's still taking a full-time salary out of the business, despite not working in the business, which is meaning there's limited cash flow to invest in growth because his dad's still taking a salary out, and that's just the structure of how they've done the deal. But so there are scenarios where the offspring can be more entrepreneurial, but then they're held back by other means. So it is a tough one.
It's sometimes a case, and this isn't just specific to family businesses. Actually, I think it's something you see in business generally. Is that business owners sometimes ultimately they get tired. They've been running a business for however many years, and they might not be the most up to date with technology. They might not be able to see the wood for the trees, and businesses can become a little bit stagnant. Actually, unless you're reinvigorating that with new blood and new ideas and all the rest of it. And sometimes we see buyers out there who are looking for those business owners who are maybe haven't grasped change and opportunity and what have you, because they see that they can potentially buy that business at, frankly, a bit of a discount and maximize all of those opportunities that the existing owner could have actually made the most of. And that's flipping it around from a buyer's side. That's what we quite often see, is that they're looking for businesses who potentially have good reputations, but are not the most efficient in terms of their workflows, or in terms of their cost saving, or in terms of maximizing client revenue. And actually they say, I know I can buy that business and I can immediately add 10, 15, 20% to turnover because I just can do it better.
Yeah, I see that. I mean, particularly in the accounting space at the moment, I see a lot of acquisitions or a lot of acquirers looking for unsystemized businesses, so they can systemize them, make them more efficient, but then also look to upsell new products and services, so you get a more profitable business generating higher revenue, which giving you a significantly higher return. So absolutely. So that leads us nicely on. So we understand there the kind of key options and the pros and cons of each of those options. So I'm 3 to 5 years out. I've decided what route I'm going to take. I know what the pros and cons of that are in terms of the options. What in your view, what in your experience are the key elements to maximizing the value that I'm going to take out of this business on exit?
So I think the starting point always comes back to figures. Actually, you need to have a proper understanding of your figures in terms of your turnover, your profitability, your cost base, what your savings what efficiencies you can make where you can, having proper management accounts, proper forecasts about where you're going. That just demonstrates a very organized business. And actually, when you've got a prospective buyer and they're looking at going, can I have management accounts? Oh, we don't do management accounts. It just gives a slightly negative perception and ultimately will impact on the value that you get out of the other end of it. I think having a clear management structure in place, actually, it's a test of, can you go on holiday for a month and not have to pick up your phone and run the business? Does that business run itself without you? Because again, looking at a buyer, and particularly when you start getting bigger businesses and you might be attracting interest from like some private equity and things like that, they want to be just, right, we'll put the money in, we'll buy it, but we don't want to run it. And those businesses are worth far more because anyone with cash can buy it and then not have to get stuck into the day-to-day. So businesses that run itself, that have strong incentivized management teams will inevitably attract more. Businesses that can show strong recurring revenue, so whether that's customers on retainer or long-term contracts, things like that. We've done some work in the energy sector and things like that, and some of their customers, they sign 5-6 year deals. So actually, a buyer is guaranteed, well, I know what my revenue is going to be for the next 5 or 6 years. So that means a multiple is going to be much higher on that, because a buyer is not thinking, well, I need to constantly churn for new revenue, new customers. It's very similar. You mentioned the accountancy space. Actually, their values is driven by the amount of their recurring revenue. Yeah, recurring income, basic compliance, actually, things like employment contracts up to date, GDPR compliance, regulatory compliance if you're in a regulated industry, whether it's CQC or an O license or whatever, actually showing strong compliance will get you a higher multiple. If you're something in a tech-based industry or technology is fairly central to your industry, that can reap higher rewards, showing that you've got either some exclusive rights or you've developed something unique and you've got where appropriate trademark or patent protection. Again, something like that will get you a lot of value because it can't be replicated. So there's lots of steps, and that's just some of them we've covered off there. But this goes back to getting the plan in place and getting the right advice, because the right advice is specific to your business and specific to your industry. These were some very general points that we were talking about, but there's something that run across all business. There's been some very specific ones relating to certain sectors, how you're financing new assets, for instance, what assets you own, how you deal with things like invoice finance and asset finance and things like that are a bit more specific to sectors, but actually, again, using the right way can maximize your value.
So basically, in summary, and there are always exceptions, but make sure you've got robust financial figures with all your assumptions and such like in place. Make sure you've got all your kind of contracts and your due diligence in place in terms of employee contracts, client contracts. The longer you can predict the revenue, the more secure your team, the more that business will run without you, the higher the value is likely to be. And I think, as you've alluded to a couple of points through this, is that if you've got any skeletons in your cupboard, they're going to find them and they're going to use them as an opportunity to chip away at price. So whether it be a couple of dodgy invoices you've slipped through, or a couple of deals you've done, or anything at all that isn't squeaky clean, is going to be an opportunity for them to chip away at price and mean you put less money in your pocket, right?
Correct. Yeah, absolutely.
So I'm a business owner. I'm looking to exit. I've got a plan that's 3 to 5 years out. I know what my options are in terms of, which vehicle to adopt, what my key priorities are, I know what the pros and cons are. I know how I'm going to maximize value. What are the common mistakes that small business owners make from your experience?
Well, the first one obviously is not preparing, is I suppose, not having that plan and just waking up one day and going, you know what, I'm selling my business today, I've had enough. They will quite possibly sell their business, but probably won't get the most out of it. But looking beyond that, I think it is a case of actually, clearing out the dead wood. If you've got a dispute with an employee or a customer or a regulator or whoever, get it sorted, get it out the way, because you don't really want a buyer poring over this information and seeking indemnities and all the rest of it. It's probably something that's going to have to come up in the disclosure process, but at least if you can say, right, we've settled that off, we've sorted, it's all clean, we've got a clean bill of health, that will make things much easier. Another key pitfall we see, particularly with trade sales, is you get two parties who your buyer and a seller who are coming at the deal from a slightly different perspective, and potentially they're both equally confused about what the deal ultimately is. And to give you an example of that, we saw a deal which buyer offered, we'll say it was £2 million. I can't remember what it was, but let's say it was £2 million. And the seller had accepted that on the assumption that they were also going to get the £700,000 worth of cash in the bank in addition to the £2 million. The buyer had offered £2 million because he knew there was 700 grand in the bank. So he was going, well, I'm paying you 2 million, but I know there's £700,000 worth of cash in the bank. And the seller's thinking, well, I'll accept the 2 million because I'm going to get the £700,000 in addition. Fundamental misunderstanding as to what the deal was. That came to us actually from somebody else, and actually when we started picking it apart, it became clear that we're talking about two very different things. But actually, the point being is you need to both be on the same page fairly early on before you start incurring costs as to actually what is the deal and how's that going to be structured. Another pitfall I mentioned earlier about the fact that most deals now involve an element of deferred payments. Understanding fairly early on actually what's the security around that, what does the seller expect in terms of security, and what's the buyer willing to give in terms of security. And there's lots of options about how that's going to look, but there needs to be a meeting of minds fairly early on, because you don't want to spend a load of money on legal and accountancy work to get to the 11th hour and the seller's going, well, I want the buyer to give a personal guarantee on the deferred payments, and the buyer go, I'm not giving a personal guarantee, and I never said I'd give a personal guarantee. The personal guarantees are not the only option. There's lots of other options, debenture, charge over shares, cross-company guarantees, things like that. But you need to get that understanding early, because you don't want to get a deal to the 11th hour that falls down because actually there's been a misunderstanding as to what that security is going to look like. So there's lots of potential pitfalls. The best way to avoid those pitfalls is to make sure you get the best advice early on from the right professionals. So your three core ones, I would say, appreciate, I'm a bit biased here, but I'm going to say get a good lawyer, get a good business advisor, and get a good accountant. Because they'll each give you different advice around it and a different perspective. There might be other ones that then fall off the back of that, maybe your IFA and things like that. But I would say that's your three core ones, because they will give you linked but different advice on the same issues.
Yeah, I think it's key. And, what you've been alluding to there for the last few minutes is, get rid of that ambiguity in the heads of terms. Is the heads of terms saying we're both on the same page, we've both got the same expectations, we've both got the same valuation in mind? Yeah, I've had a client recently who signed heads of terms with this potential buyer, and then they started to move the goalposts. So he said, I'm not selling. I'm done. And he used that as an opportunity with a bit of brinksmanship to play hardball. And he said, look, that's what I've agreed. I wasn't even looking to sell. My business was prepared to sell. I'm in a position where I can sell. And I think that, that's one thing we've probably not covered off too much today. That's another debate for another day, is get your business ready for sale, even if you don't want to sell. And then if somebody comes knocking, then great. But they decided to change the goalposts in the head of terms, and he said, no, either it's my way or the highway kind of thing. And they eventually came back cap in hand and said, yeah, okay, sorry, we shouldn't move the goalposts. And it was all brinksmanship.
Yeah, you will always, I won't say always, but there's a reasonable proportion of time when buyers will try and chip you, and sometimes that is justified. Sometimes there's an identifiable risk or market condition or something like that. Maybe your financial performance has dipped or something like that. There's a reason. Sometimes it's just because the buyers are just playing the game, much as in the same way as you see it in property transactions, residential property and things like that. People try and chip at last minute. It happens exactly the same in business, and it's understanding what your own hard line is and what ultimately what you want out of it. But rely on your advisors. For most business owners, this is probably the first and only time that they will go through this process. For the likes of yourself and myself, Gary, we see this all the time, and we advise on it all the time. We can spot when people are playing the games, and this is where the value of good quality experienced advice comes in. You don't want to be using a solicitor or an accountant or whatever who's got limited experience of this, because they won't spot where these issues potentially come in.
Of course, yeah. And look, again, I've got another client recently who's been offered an eye-watering sum of money to sell his business, but couldn't get security on the deferred consideration. And thankfully, his lawyer said, "No, we're not touching that with a barge pole because there's no guarantee we're going to get that future payment, and therefore we're going to take a different route." But without that right legal advice, without the right mentor or expert to get you the plan, and without the right accountant to do all the number crunching, you're going to be left exposed, and somebody's going to chip away at the price, and you're going to finish it with a lot less money and a lot more compromising than you would have done.
Absolutely.
So having the right advice around you, and today's just a flavour in terms of some of the questions to ask and some of the things to think about. The good advisors around you should pay for themselves time and time over in a sale transaction, shouldn't they?
Yeah, absolutely. Absolutely. I think we've seen many transactions on both buy side and sell sides where we can demonstrate that actually the amount that we've saved them in tax or some other loss or something like that is significantly greater than the amount that we've charged in the first place.
Yes.
And we've not gone into some of the complexity around cash extraction from businesses on sale, and actually how you can manipulate cash extraction in a way that's much more tax efficient, rather than saying taking dividends and all the rest of it. You can in a year leading up to a sale, for instance, actually if you can afford not to take dividends or reduce the amount of your dividends, you can save yourself 10-20% tax rates by leaving it to then fall part of the sale prices. There's lots of different options, but that's where your professional advisors come in. That's not where your friend down the pub who sold their business will necessarily know the ins and outs of it.
Yeah, absolutely. Richard, I can't thank you enough. You've shared a lot of insight today, and I'm sure there's many small business owners that are starting to think about exit, or they've even started along that process to exit. And I think you've given certainly me a lot to think about in terms of some of the clients that I chat to on a regular basis, but I'm sure those watching and consuming this webinar at a later date. So I can't thank you enough. So just to say thank you. So last question, just to close off. So what should somebody that's looking to exit do next? I mean, you might have answered that question, but just in a one-liner, what should they be doing next?
I think the starting point for anyone looking for an exit is speak to your professional advisors, potentially even do a collaborative meeting with all of your key advisors, your accountant, your lawyer, your business advisor, your spouse or partner, anyone else who's got some sort of vested interest or otherwise, and just explain actually what is it your aims are. What's your aims and objectives, what's your timeline, and then listen to what your advisors have got to say. Even if that's just a first exploratory meeting 5 years out, you'll get some nuggets to come from that, and and then actually you'll get start forming an outline plan to go, right, this is what the next 3 to 5 years looks like. So, but don't be afraid to get advice. That's really your starting point. And then put in place a plan.
Fantastic. Richard, couldn't have said that better myself. Thank you so much. Thank you. So thanks for all of those that joined us today. That's Gary King from Tendo, and in discussion with Richard Coulthard, who's the Director and Head of Commercial Services at Ice & Harrison, talking about preparing for exit. Richard, thank you.
Thanks for having me today.